Good day to all, my name is 𝗪𝘃 and I'm from the research team at 𝗪𝘆𝘆. Today, we've got something exciting to dive into, and that is the Fidelity American Growth Fund. It's been making waves in the investment world, and we're here to tell you why it should be your number one fund pick for market exposure. So what exactly is the Fidelity American Growth Fund? Well, it's a mutual fund offered by Fidelity Investments, one of the giants in the financial world. The fund aims to provide investors with long-term capital growth by investing in US companies. But wait, it is not just any companies. It focuses on those with growth potential, aiming to ride the waves of innovation and progress. Its core investment thesis is to identify companies that are most likely to benefit from secular growth trends and themes such as mobility, automation, demographics, and electrification. And within an overall growth context, the portfolio managers are also valuation sensitive and aim to find the best risk to reward ratio to implement the growth theme. But here's where it gets more interesting. The performance of this fund has been nothing short of impressive. Over the years, the fund has managed to outperform its peer group by providing investors with an annualized return of 8.2% compared to 6.5% returns by the latter. And on a calendar year basis, the fund has also managed to outperform its benchmark in 3 of the past 5 years between 2018 and 2022. While its returns may only be slightly better compared to the peer average, what is impressive is that the fund delivered this performance with a maximum drawdown of just 34.1% over a 5-year period, as compared to a maximum drawdown of close to 40% by its peer group, which is a testament to the portfolio manager's stock-picking skills and quality-focused investment philosophy. In addition, the downside volatilities across a 3-year and a 5-year horizon have also come in below peer averages. So there you have it, folks, the Fidelity American Growth Fund, a powerhouse of potential backed by solid performance, expert management, and a strategy that's designed to keep you ahead of the curve. So if you want to ride the wave of American innovation, this fund should be your top pick. To get a full analysis, scan the QR code or click on the link in the description below. Up next, Cyrus will be sharing more about a worthy challenger to the dominance of Australia's Big Four banks. Over to you, Cyrus.
Hi all, today I'll be talking about bonds issued by Macquarie, the latest challenger to Australia's Big Four banks. Macquarie Group started as an investment bank in the 1960s, but today is much more than that. And this includes its 2 divisions under Macquarie Bank, namely the Banking and Financial Services segment, as well as the Commodities and Global Markets segment. Macquarie Group reported yet another strong performance in FY23, with net profits climbing 10% after an already high base after FY22's plus 56% growth, giving the company 54 consecutive years of profitability. The Commodities and Global Markets segment was a key driver, helped by volatility in commodities markets. And with energy markets looking to remain quite uncertain, we think that this segment can continue to support earnings for the whole group. Another segment to watch is the Banking and Financial Services or BFS segment. BFS saw net profits grow 20% year-on-year, helped by improved margins as well as growth in its loan portfolio. With inflation remaining persistently high, we think interest rates are also likely to stay higher for longer, which could also continue to support margins moving ahead. Its key capital and liquidity ratios also remain comfortably above regulatory limits. On a group level, Macquarie Group maintained a capital surplus of 12.6 billion Aussie dollars, representing a Tier 1 capital ratio of 15.2%, well above the 10.25% minimum. On a bank level, as you can see on this table, many of its ratios also have a decent buffer compared to regulatory minimums, such as the leverage ratio of 5.2%, well above the 3.5% minimum. Given the solid outlook for Macquarie Group and Macquarie Bank, we think their bonds look also pretty attractive. We've listed 4 bonds denominated in Sing dollars, Aussie dollars and US dollars. The 4.5% Sing dollar and 4.15% Aussie dollar bonds are senior unsecured bonds and provide decent yields for their solid credit rating of A by Fitch. But if you have a slightly larger risk appetite, you can also consider the 6.082% Aussie dollar or the 3.624% US dollar bonds, both of which are Tier 2 subordinated with a BBB+ rating from Fitch, and these will also come with a decent yield pickup as well. To get a full analysis, scan the QR code or click on the link in the description below. Thank you so much and see you next week.